Class is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. Bobby Rains here for our once every 3-week members-only workshop. Welcome to all of you and happy Wednesday. All right, our agenda today is the same as it normally is. We'll talk about what's going on in the market, what's going on in InvestorsObserver, and then member-driven content. So questions, I got a couple questions ahead of time. Thank you to, I think it's Lee and Jeff for sending those in. And then, any other questions you have, you can put them in the, question box at any time, and I'll either get to them, sort of in the moment, if it's relevant to that, or if not, I'll come back to it at the end. And again, all you have to do to get a question in is, I think both of the questions I got this time, somebody just replied to the invitation we send out. That's a pretty easy way to send in a question and let me know that it is for the workshop. All right, so this is a chart we've been looking at for a while. It's 2 years of the S&P 500. We've been kind of in a range here for a while. Earnings could break us out, I think, really in either direction, depending on how the numbers come in. But we also, have a ways to go to the top of the range or to the bottom of the range. So the range down here. Yeah, we have a ways we could go without really breaking out either. So it'll be interesting to see how that goes. Oh, hang on a second. I don't think my screen is visible. There we go. All right. So yeah, top of the range, bottom of the range is here, or even here. So yeah, we have some ways we could go in either direction there, depending on earnings and whatever else happens to pop up. All right, so this is the last 6 months. It's just a little cleaner. We're back to, this is more sort of this. We talked about these big candles and long wicks and gaps. Tends to be a less predictable, less easily tradable market than, if we go back to say this period, there's a few gaps, but not a whole lot, and not a lot of long wicks either. Right, obviously this is great. That doesn't happen very often though. But yeah, we generally prefer sort of more consistency. Whereas this and this are just sort of sloppy, and it's really hard to know what to expect from one day to the next. All right, so this is not an updated chart. This is actually the chart from last time where we talked about how the big sell-off in bonds seemed to have reversed quite a bit, and it helped push stocks back higher too. All right. This is the updated version of this chart. You can see that the reversal of the reversal has itself reversed somewhat. I think that's the right number of reverses. In any case, it was going down and then it went up and now it's going back down again. Getting a lot less fanfare here. That blue line is the yield on 10-year bonds. Generally, that's just a sign that people are not super optimistic about the economy going forward. It's somewhere, I think, a little north of 1.5% today, which, if you're willing to take 1.5% return per year for 10 years, that's a sign of somebody who doesn't think there's a lot of opportunities somewhere else. And again, you can see we're not to the bottom of the range from when bonds bottomed out here, but not super far off of it either. I don't expect those things to correlate sort of one-to-one. We originally started showing this chart because this gap is wide on a sort of historical basis. It tends to converge over time. So that's what we started doing there. Generally though, on bonds, since I think this is 1981, when things peaked, right? It's the right interest rates were super high. That's the Volcker Fed, beating inflation. May have killed it and not just beaten it. We'll see if inflation ever really comes back in a real sense. But yeah, it's just been sort of a steady, sometimes not so steady. But yeah, over the last almost 40 years, yeah, yields, the trend has been always lower. We still have a ways to go before we get to zero, which is what has happened in Europe and some other parts of the world. And it seems a little unlikely that that would happen here, but I suppose not impossible. People are willing to pay Greece for bonds at this point. So I certainly wouldn't have expected that in 2011 or 12. So we'll see how that goes. All right, what else is going on? Trade, still no one knows anything. The big player here is obviously China. Europe, there's still some things going on there as well, but China is the big one. China has said they're willing to do a smaller deal, something that's sort of not all-encompassing. It's hard to know exactly, A, what that would mean, or B, whether or not the U.S. negotiators would accept it. The president has said he wants a big overarching deal. And so that's kind of where that comes in. The interesting piece here is these new human rights sanctions and blacklists and visa bans that have popped up in the last week. Talks are supposed to start tomorrow. There have been some lower level talks earlier this week, and then the high level talks are supposed to start tomorrow. So adding all of these things ahead of time certainly seems like it links them together. It's really hard to know if they're actually unrelated or if they're designed to be something that can be easily given back. Linking human rights issues to a trade deal doesn't seem necessarily like the best negotiating strategy, unless you want to negotiate either a really giant deal or honestly just sort of wreck the talks altogether. It's impossible to know exactly what the motivation is there in terms of why exactly that timing. The Fed obviously continues to really sort of dominate things on the non-trade side. And based on everything Jay Powell said yesterday, he was, I would say, probably more dovish yesterday than the minutes that came out this afternoon, but the minutes are from 3 weeks ago, so I would go with what he said yesterday over what he said 3 weeks ago. It seems like another cut's probably coming in October and potentially another one after that before the end of the year. There is some balance sheet expansion people are talking about. I've noticed 2 different financial TV channels arguing yesterday and today about whether or not it's quantitative easing. My opinion is it's not, based on essentially what the purpose of it is. Quantitative easing was a plan to come into the bond market and make big purchases on a large scale with the goal of moving interest rates in those markets lower. This is not that. This is the Fed needing assets to try to keep the repurchase market, which is sort of financial plumbing is probably the best way to say it, right? Like, so if you think about a bank has $1 trillion of assets, which very little of it is cash, and $1 trillion of liabilities. These are the big, JP Morgan, Bank of America, those guys. Right, you have a ton of assets and a ton of liabilities, and sometimes you get a little bit of a maturity mismatch and you find yourself short on cash, so you go to the repurchase market, is essentially what that is. It's basically plumbing, right? Like, the bank's not insolvent, they're just short on cash today. They have trillions of dollars of assets. They just need a little cash today. And so the Fed needs assets in order to keep that market functioning properly, which is what's going on here. I don't really expect you'll see a noticeable difference in the in bond rates. For example, it really is designed to sort of help the Fed keep rates in the repo market within that target rate. The rest of that speech was actually pretty interesting. You can go find it on the Fed's website if you're interested. He talked about the risk of a gas price shock to the economy, which, it turns out there's sort of less risk of that, and he seems to think the market or the economy could handle it better than it would have a few years ago. And then he also talked about some interesting things in terms of measurement of both productivity growth and unemployment rates, which are two measurements that have sort of seemed a little bit broken in the last couple years in terms of what the economy looks like and how the data has come in. Generally across the economy, I don't think I changed this bullet at all. Some data is softening here and there. The consumer remains strong. Some of what we're seeing in the data softening is, a lot of it's in like business investment and things like that. And that is, with a strong consumer, you expect, right? Consumers are buying things. Companies have a chance, should be getting more money. They can spend money to expand. But I think what we're seeing is a lot of policy uncertainty in terms of what will tariff rates be, what will tax rates be, all of those things that's keeping some of that corporate spending on the sideline that would otherwise be helping the economy. And on Brexit, it's the same as trade. I don't think anybody actually knows anything. It still seems pretty much like there's no actual plan, and I'm not entirely certain that there's a plan to have a plan. I think probably based on what I've read recently, an extension seems like the most likely outcome, but honestly at this point, who knows? All right, so that is the market update. We do have, some of you have probably seen an email from us teasing a big announcement that's coming soon. I was hoping to have something more closely resembling a time frame for that today, but I don't as yet. But we do have a big announcement coming soon. You'll get, I'm sure, plenty of emails about it. And also, we'll probably do another one of these sessions also, so you guys can ask any sort of questions or anything like that, and we'll go over what things look like. All right, so with that, it is on to the questions. The first one we got was, can we discuss iron condors, the strategy and construction, when and why to use an iron condor, and the advantages and disadvantages? So the strategy is essentially, it's two vertical credit spreads. There's a bullish one and a bearish one, and they are on either side of the stock price. So what you're essentially doing is betting the stock will stay in a range, right? Doesn't go up too much, doesn't go down too much. You basically win on both of those credit spreads. The reason people like them, I think the big reason is that you get two credits, right? So if you think about, right, a credit spread, you put, essentially the strike price less the credit. So let's say we did $2 on each side. We did $2, $2 wide for some credit. We'll say, 50 cents on the bullish side, and then $2 credit, $2 spread with a 50-cent credit on the bearish side. Well, now you got $1 worth of credits, but your amount at risk actually goes down instead of up, because these spreads typically have the same expiration date, which means that they can't both go bad, right? If you think about it, a stock has to either go up or down by a certain date. Obviously, it can go a lot of places in between, but at expiration, a stock will either be higher than where you bought it, lower than where you bought it, or where you bought it. It can't be any two of those. It's going to be one. So you're basically doing two trades, but only one of them, one of them's guaranteed to win. The problem is you don't know which one. Potentially both of them will win, but you can't lose both of them. So you get two credits, but because you get two credits and you're not actually adding more risk, the amount you have at risk is lower, right? Instead of 50 cents on a $2 spread giving you $1.50 at risk, you have two 50 cents on two $2 spreads. So you basically have, instead of $2 minus 50, it's $2 minus $1. So the risk reward there is higher. That's why people find them attractive. The disadvantage is essentially more possible negative outcomes, right? If you do a bullish credit spread and the stock goes sideways or up, no problems, right? You're good to go. If you do a condor, the stock can't go up too much, it can't go down too much. There are more possible outcomes where you lose money, is the one disadvantage. And then, sort of a corollary to that, potentially there's a lot more management required. Right now you have two ranges where you probably don't want the stock to finish in between them, because you either end up getting assigned on a call you sold without that cover for, or you end up having stock put to you that you didn't necessarily want to buy. So those are sort of the disadvantages there. But yeah, it's a popular strategy. People like to use it, and especially now with commissions going to zero, there is still some, not minimal necessarily, but relatively small per contract commission. But you're certainly not paying, when I started in this business, $15 or $20 or $10 a few years ago, or $5. I think that really came in last year, the year before, and now everybody's at zero. So certainly you can trade a lot more and leg into and leg out of things, and not have to pay a whole bunch of commissions, which is nice, which may actually make the strategy a little bit more attractive if you don't mind doing the management. All right, and then we got a question from Jeff about the Lowe's diagonal spread. That and the First Solar covered call are at the top of my list every day. Lowe's in particular, we are looking for an opportunity to roll that call. First Solar is uncovered currently, so we're just looking for a call to sell at that point. There's no real news on Lowe's. It's just been down. It was way up after earnings, and it's come down a little bit since then. But it has held support at the bottom of its post-earnings range, which is what we're looking for. If it breaks below that, we'll definitely have a different attitude about it. But currently, where it's held support there, we don't feel too bad about it. And then earnings are not till November 19th, so we, if we don't roll the call that expires on the 18th of this month, we still have a whole another month or so to try to sell another call, at least one more call there. We could go 2 weeks or something if the price was right, depending on what the level of stock is at. So yeah, that's the strategy there, is to try to manage it, look for more premium to sell. We prefer to be out of it before earnings. We've collared things up before and had sort of mixed results with that, but it's not impossible. We would consider doing that again. Excuse me. Again, with commissions being zero, we're obviously not accounting for commissions when we track things on our website, just because it's impossible to know what everybody's commission structure is. But it is a thing we try to be mindful of, in terms of, nobody wants to sell an option that costs, brings in $20 a contract and then pay a $5 commission on top of that. That doesn't seem like it makes a ton of sense. But selling a $20 option and paying a $0 commission on top of it seems certainly less bad. So yeah, we're still working on what all of those things mean in terms of how we manage these trades. But our strategy is generally look for opportunities to collect more premium, and go from there. All right, that is the last of the pre-submitted questions. Any more questions anybody has, please let me know. All right, we got a couple of questions coming in here for. All right, Lee says, are we actually able to build a typical iron condor during the presentation? I'm not 100% what you're looking for there, Lee, but we have, yeah, iron condors available in the trade idea generator. Let me start over. I don't know what kind of filters I have in there. And so, sure, let's look at this Nike one just as an example. Yeah, so it's right 2 credit spreads, and the difference here is, yeah, this is a pretty tight range. You're essentially looking for Nike to stay between 91.50 and 92 for a week and a half. Yeah, I mean that's the gist of it. But yeah, so you get, yeah, they're both 50-cent spreads. You get 42-cent credit, so you're only actually risking about 8 cents. Which means that, right, if you're willing to step in and manage the trade, you can certainly get, yeah, right, you can certainly get some profit outside of that 50-cent range. It just won't be, necessarily the full profit. This is what I mean by more management being necessary on these kinds of things. Is that, yeah, you have that to deal with. All right. So David says, "What is our strategy for getting out of a position before expiry when it looks like it might go against us?" And we don't necessarily have a preset strategy, David. I think, yeah, a lot of trading is about, sort of tactics as opposed to strategy. I think that's right. In the sense of, right, like we try to take everything on a case-by-case basis, and certainly a strategy-by-strategy basis. Covered calls, right? You can potentially hold that stock forever. We prefer not to hold things through earnings. But even then, that potentially gives us a few months. Whereas vertical spreads, we've discussed at some length in some number of these presentations. I don't really believe in rolling the vertical spreads. So those generally, if it looks like it might go against us and I see an attractive place to get out, you try to get out. And then the diagonal spreads, again, like we talked about with lows, you can look at rolling calls and things like that and try to play defense. But I mentioned on the, in the lows example, if that stock breaks below a certain resistance point or support point that I identified, at that point I maybe start looking to bail a little harder than just, being down on the position at all. And then the next question from David is, why do we always get the portfolio trades after the market closes for the day? The reason for that, David, is so you can look at the trade, decide if you like it, and then put an order in for the next day. We send the trades to everybody at the same time. There is no preferred buy this while the market is open feed. Those are published after the market closes on purpose and for that reason. Which is trying to get everybody in at the same price. Sending things out during the day, we found, it's very difficult to get, right? Not everybody is in front of a computer all day. It's gotten to be a little bit less the case with cell phones and things like that. But, I've definitely, trade adjustments and things like that we put out intraday. I've definitely had people call and be like, oh, I was driving when this happened, or I was on a plane and had my phone, didn't have internet. How do I fix this? And yeah, I don't have an answer for that at that point. We can't, we're not a financial advisor. We can't give individualized investment advice. So our sort of way around needing to hold that or leaving a whole bunch of people with a position they don't know what to do with is to try to do as much stuff as we can after the close. And occasionally, something will happen like Etsy this morning. We put that trade out last night and the stock gapped up a little bit and then ran higher during the day. And we, yeah, didn't get filled on that this morning. Maybe we missed it. Maybe it'll come back to us tomorrow. We'll have to see. Etsy, the whole market was up today. So if the market has a bad day tomorrow, we could get back into that one, or then we'll look to either adjust or cancel the trade like we've done with some other things. But yeah, that is why we put things out after the market closes. It's just to take some of that time pressure off from people who receive an email or a text message and then have to do something immediately when it may or may not be convenient. All right, I think we may have exhausted the questions for this time around. We send out a link to the recording and to download the slides tomorrow morning sometime. So be on the lookout for that. Otherwise, our next workshop will be in 3 weeks, which is looks like October 30. So yeah, be ready for that, and be sure to send in questions or whatever ahead of time. If you have questions between now and then that you don't want to wait 3 weeks for an answer for, we're available by phone 8 to 5 East Coast time, or with the help button on the website. Thank you all for coming.